There have been 564 banks which have failed since 2001. History shows that 1,617 commercial and savings banks failed between 1980 and 1994, and another 1,043 thrift banks failed during this same time period. Today, we are being inundated with headlines about Silicon Valley Bank, Signature Bank, First Republic Bank, and most recently, PacWest Bank. But what causes these bank failures? And more importantly, what can you do to protect yourself from the fallout which these bank failures create for you and the economy? Banks receive their charter only after they have submitted to an extensive financial analysis. They must submit a business plan, create a management team, meet the capital reserve requirements, generate a risk management infrastructure, and submit any other relevant information requested by the regulators. They must get approval from the Office of the Comptroller of the Currency, and they must pay for depositors' insurance with the FDIC. They must maintain the set amount of capital reserves established by the Federal Reserve, or they lose their charter. When regulators get lax, however, and allow banks to get by without following these stringent regulations, banks become vulnerable to bank runs. And when a bank run occurs on a bank, the bank has no way of satisfying every depositor who wants to withdraw their money, because capital reserves are only a fraction of what a bank has taken from its depositors. Moreover, when a bank lends money excessively, as these banks certainly did, it actually increases the money supply. In fact, 97% of the money supply today has been created by banks lending money. This ability to create money is unique to banks. No other institution, or even you or I, can lend money to somebody else unless we have it and own it first. When you or I, or a non-financial company, or a non-banking financial institute lends money, our balance sheet remains the same. But when a bank lends money, their balance sheet is altered because the loan doesn't negate their asset column, but instead is added to their liability column as a positive number. This is why the adage, loans create deposits, is a fact. The bank, by lending money, creates money out of thin air. So what about non-banking finance institutions like life insurance companies? How do they get their charter? And do the regulations they fall under differ from banks? Well, life insurance companies receive their charter only after they have submitted to an extensive financial analysis. They must submit a business plan, create a management team, meet the capital reserve requirements, generate a risk management infrastructure, and submit any other relevant information requested by the regulators. They must get approval from each state comptroller where they intend to sell products, and must contribute to each state's guarantee fund they sell product in. They too must maintain set amounts of capital reserve established by each state insurance commissioner's office. By being regulated by states instead of federal bureaucracies and private organizations like the Federal Reserve, life insurance companies have been prevented from failing like banks over the past 20 years. Compared to the 564 bank failures since 2001, only 8 life insurance companies have become insolvent over that same time period. Unlike banks, life insurance cannot create money out of thin air when they provide loans to their policyholders. A policyholder can only borrow against the equity which they have developed in their own life insurance policy. Thus, a policyholder becomes part of the life insurance company's portfolio when they borrow against their equity, and even this process increases the profits of the insurance company as policy loans are drawn on the capital reserves of the insurance company. So how can we avoid the risk which banks' failures pose to depositors and the entire economy? The answer is pretty plain and simple. Keep more money in life insurance contracts instead of banks. In doing so, you will have a guaranteed ability to leverage your equity, which is an asset called cash value, without having to give up the growth of your equity. Sean Tolley understood this when he wrote in Fortune magazine way back in September of 1993. The cost of borrowed capital shows up as an interest expense on a traditional loan, Tolley wrote. But the cost of equity capital is nowhere accounted for on the balance sheet, and therefore the cost of equity capital is extraordinarily expensive. This is the key to avoiding the risks involved with bank failures. Leverage the equity in your life insurance because you can do so without experiencing the extraordinary expense of spending your own equity. In fact, you can become like the banks and borrow money from the insurance company, which is then added to your balance sheet without negating your asset column. This is because the loan balance is added as a positive to your liability column on your balance sheet, just like banks are allowed to do. Thus, a loan creates a deposit for you without reducing your assets, just like in banks. In the non-banking world, this process is called economic value, or EVA, and has become a major financial metric since 1993. So you do have a choice. You can continue to borrow from banks and pay the cost represented here in the red columns. You can even borrow to invest, as represented here in the yellow column. You can also choose not to borrow money, but simply save money, as represented here in the green columns, and hoping inflation doesn't cost you more than what you can earn while you're saving. Or you can choose EVA. Leverage your equity, or cash values, invest those dollars, and reap the rewards of becoming your own banker, as represented here in the gold column. A word of caution. Many are recommending the use of indexed universal life as the place to build your equity for becoming your own banker. There are several difficulties which complicate this recommendation. Number one, insurance companies don't have to maintain as much capital reserves for indexed universal life products as they do for when they sell a dividend-paying whole life insurance product. This makes companies who sell IUL policies more vulnerable to a run on the bank. The cash value in indexed universal life isn't really equity, but merely a representation of interest earned on overpaid premiums. There is no provision in any IUL contract to share in the profits of the insurance company, and so all the growth in an IUL, indexed universal policy, their cash flows are still the result of overpaid premiums and any interest which has been earned on those overpaid premiums. Number three, the cost of insurance increases continually in an indexed universal policy. This can and frequently does compromise the cash value growth and the constancy of the IUL policy itself. Number four, interest paid on policy loan increases the insurance company's profits, and because there is no profit sharing with policyholders, this destroys the economic value added of borrowing against the cash values in an IUL policy. With dividend-paying whole life insurance, you keep the economic value the policy provides, while you also get to keep the value of the asset you purchased or invested in, with the money leveraged against your policy's equity. Owning dividend-paying whole life insurance can eliminate the risk of losing money when banks fail, create economic value added and generate greater profits, recover capital costs associated with financing, increase your cash flow, overcome the cost of insurance over time, save you money when you fund buy-sell agreements, when you fund non-qualified retirement plans for yourself or your employees, when you reduce your taxes by claiming the interest deduction, and when you fund IRS-approved defined benefit plans. State governments receive large shares of their revenue from life insurance companies doing business in their states. Thus, life insurance companies are held to a tighter and more rigorous standard than banks because local governments have a direct interest in the success of life insurance companies. They want them to remain solvent. Banks, on the other hand, are regulated by distant bureaucrats and private organizations like the Federal Reserve. This leads to less regulatory scrutiny, accountability, and oversight, and is one of the main reasons so many banks have failed over the past. At Life Benefits, we understand life insurance and the banking process. That is why we encourage you to become your own banker by leveraging the equity, the cash value, in your dividend-paying whole life insurance. We own, we teach, and we sell dividend-paying whole life insurance. Call us. We can help.